My name's Andrew Stotts from Maybank Kim Eng, and today I want to talk to you about my latest original research on buybacks. I'll look at buybacks in Thailand, but first let's start with buybacks in America. First, what we know about buybacks is they're an alternative for when a company has a lot of cash. In some cases, a company will pay out dividend. In other cases, the company will, of course, invest in the future. But if both of these are exhausted, they may decide to buy back shares. So we could actually calculate three returns that come from a stock, from holding a stock: the capital gains return, a dividend yield, and also a buyback yield. In the US, buybacks have been really popular. In fact, in 1999, the value of buybacks exceeded the value of dividends. Let's talk about the reasons for doing it. The first reason is if a management team is compensated by share options, sometimes doing a buyback will help them make more money in their shares. So there's an incentive there. Also, if there's uncertainty about earnings, say you had a really good year, you don't want to pay out a massive dividend to have to then cut it in the next year. So you could either issue an additional amount as a special dividend or as a buyback. And then, of course, investors' profiles are changing. Some hedge funds and other types of investors may prefer the capital gains that come from a buyback over the dividend yield. And also we have an EPS impact. If nothing changes in the business and we reduce the number of shares outstanding, EPS should rise, and when that happens, the PE falls. So if that's the case, that would cause you to own a cheaper stock, or the stock starts to re-rate to get there. And finally, tax efficiency. In the case of the US, the gap between the dividend tax and the capital gains tax has been pretty high, with capital gains now on long-term rate at about 15%. And so there's been an incentive to do buybacks so that people use the capital gains rate. That rate's probably going up as we see the US is in a lot of debt at the government level. Now, let's look at the US for a second. If we look at the dividend yield history, on this chart I look at going back all the way to 1900 and calculate the dividend yield on average per decade. And it's been falling since 1970. That's when a lot of the tax changes started happening. What we can see is a study that I found that I was looking at that looks at a period of about 5 years in the US and tries to identify what is the buyback yield. You can see the yellow bars showing that the dividend yield fell each year. We saw that in the chart I showed you prior. But what we didn't see in the chart prior was the buyback, and here's the estimation of the buyback yield. So though dividend yield was 1.4% in 1998, what you'll see is that when you add back almost double that in buyback yield, you get to roughly 3% in buyback plus dividend yield. This is the number that should be compared to prior dividend yields before 1997. Now, when we look at the US, we can see that if you buy a stock that has announced a buyback, in general, that stock is going to outperform the market going forward, and this graph shows the degree of outperformance relative to the overall market. It's almost positive almost every single year. Now let's look at an example about buybacks on a balance sheet perspective. How does it impact the balance sheet of a company? This is an example of Jasmine, a company that's in our portfolio and that also is buying back shares. I'm showing a simplified balance sheet. At the top of it is assets, liabilities, and then I look at the equity section. A buyback is entered as treasury stock, in bought terms in this case, as a negative. So it's reducing the amount of total capital outstanding. That's the price that they bought it back at times the quantity, the number of shares that they bought it back at. And so what this shows us is that at times they can even, they'll write down the value of these treasury stocks to 0, as happened in 2011, and then if they buy more, those will come in again as a contra account. Now, let's talk about buybacks in general in Thailand. What we'll see is that the SET's allowed it since 2002. We've only had 76 companies that done it. 60% of the times our research is showing that you would outperform by following it. So it's not as successful an indicator as it is in the US. And we see that that real big gain happens during crisis. When the share prices collapse, companies buy them. And also, really, we know you've got to be a cash-rich company to do it. So maybe that may just mean that when we're buying a buyback company share, we're buying actually the share in a company that's already pretty profitable, and that could account for some of that outperformance. Now, let's take a look at it. What we can see is that most of the time you'll outperform if you buy a buyback company in Thailand. But you'll see also that if it was during a crisis time, after the 2008 crisis, we can see that you would have made excessive returns. So if you see the market collapsing and you see the company starting to buy back shares, that's the signal that gives you the highest return in Thailand. What we then did is look at the amount of cash on the balance sheet of all those 76 companies before they did their buyback. And what I saw is that 10% is about a threshold. You got to have more than 10% of cash relative to assets before it makes sense probably to buy back. So we can use that as a guideline. If a company has more than 10%, they're eligible. It doesn't mean that they're going to buy back. Many companies will say they'll never do that. But it gives us some kind of guidepost. Now let's look at the past in Thailand. In Thailand, you can see these are the major buyback companies, CPF, Jasmine, and Lee Feed Mill, another one. And what you can see is the recent buyback companies have been Lee, Jasmine, and RS Promotion. Those three companies could continue to be good investments going forward. Also, I looked at 5 companies that had a cash level above 10%. Hana, Delta, SVI, Lana, and also MCOT. Doesn't mean that they're going to do buybacks, but they have the potential to do that. So if we look at Jasmine and we go back, we can calculate that dividend versus buyback yield and find it was as high as 20% in 2009 because of the massive amount of buybacks. Now it's back down to about normal, about 4% as of year-to-date 2012. So let's talk now about our portfolio. The portfolio that I've got, it's got 9 stocks in it. I've made no changes in this particular report, so I stick with the ones there. And what we can see is that the performance of the portfolio is starting to rise. We're doing relatively well in these days, thanks to some of these stocks like Staycon, and also the other stock, Jasmine, has helped us quite a bit. So we're outperforming our main benchmark, which is the Set 100. That's our benchmark because we choose out of about 100 stocks. So that's the performance right now. We're going to try to keep it up as best as we can. So what I'd like to say is thank you for listening.